Welcome to the Deep Dive. We're Talk Tickers, and today we're digging into PowerFleet's Q1 FY26 results. That's ticker AIoT.
Yeah, it was a really dense call, operationally speaking. Our goal here is to, cut through that complexity.
Right. We want to focus on the actionable stuff, specifically their financial execution and this commercial transformation they're pushing.
Exactly, because when you look past the maybe integration noise, the picture is pretty clear.
I agree. The overall feeling we got was, well, strong execution, a real decisive shift towards those high-margin recurring revenues.
Which makes the outlook cautiously bullish, I'd say, even with some of the external complexities they mentioned.
Definitely. So let's start with the results snapshot, because it was, well, a significant beat.
An unmistakable beat, yeah. Let's hit the highlights.
Okay, top line, total revenue, $104 million.
Which is up 38% year over year. That's a big jump.
It is. But importantly, for Wall Street anyway, that $104 million was about $1 million above the consensus estimates. That shows discipline.
Absolutely. But I think the real story, the magnitude of the beat, was in the profitability and the quality of that revenue.
You mean the adjusted EBITDA?
Yeah. $21.6 million. That's a huge 58% increase compared to last year.
58%. Wow.
And again, beating consensus there too by over $1 million. It really suggests those cost controls are kicking in maybe faster than people expected.
And the engine driving that profit jump.
High margin services revenue. That's the key metric. It grew 53% year over year.
53%.
And 6% just from the previous quarter, hit $86.5 million. That is exactly the kind of sticky recurring revenue investors love to see.
Okay, but let's quickly address the complexity you mentioned.
Yeah.
People looking at the report will see GAAP losses, right?
Right, and that's important context. Those losses are expected, actually. They stem from about $4.6 million in one-time charges.
Mostly integration stuff.
Exactly. Integrating mix, some restructuring, system upgrades, things like that. They're temporary costs.
So the underlying operational health, shown by that 58% adjusted EBITDA growth, is what really matters for the ongoing business.
Precisely. That shows the real sustainable financial health beneath those one-time charges.
Okay, good. So let's unpack that revenue mix then, because this feels central to their whole story, shifting from hardware to more of a SaaS model.
Absolutely. Management's been hammering this point, and the Q1 numbers really back it up.
So the key metric is?
Services revenue as a percentage of total revenue, it hit a record 83% this quarter.
83, wow. That was up from 79% just last quarter, wasn't it?
It was. And, their long-term target, the ambition, has been 85% plus. They're almost there already. It's quite the jump in one quarter.
Why is hitting that 83%, that high recurring service revenue number, why is that such a big deal?
Well, it fundamentally changes the risk profile of the business, Yeah. Companies with 80% plus recurring revenue generally get valued higher.
Because it's stickier,
right.
More predictable.
Exactly. Much more resilient if the economy turns down. Hardware sales can be lumpy, very discretionary, but these services, they become essential to how the client operates day to day.
So hitting this mix confirms the integration is working and people are buying into the platform, not just the hardware.
Yes. That's the validation right there.
And you can see that flowing through to the margins too, right? Service-adjusted gross margins were? What was the number?
An impressive 76%.
76%. That sounds, well, pretty healthy.
It's phenomenal unit economics, really. It shows the Unity platform model is efficient. The cost to deliver that service is low compared to the revenue it brings in.
And for the whole company. Adjusted EBITDA gross margins
reached 67%. That's a 300 basis point expansion, solid improvement.
Okay, and that wasn't accidental, you're saying. It's proof of discipline.
Right, and part of that discipline is definitely the synergy capture.
They pulled in $11 million in annualized savings just in Q1. That seems fast.
It does feel aggressive.
Is there a risk, you think, that they cut too deep? Compromised innovation, maybe? Especially when they're pushing new AI stuff at the same time.
That's always the question with aggressive cost cutting, isn't it? But the commentary suggested it was pretty surgical.
How so?
Well, they hit that $11 million, which puts them squarely on track for the $18 million target for the full year, mainly by leaner operations globally, and getting rid of redundant vendor spending from the combined companies.
So cutting fat, not muscle, is the idea.
That seems to be the case. It looks like they protected R&D for those new AI products while still finding significant savings.
Okay, let's shift to the balance sheet then. Leverage is always a focus after big integrations like this.
For sure. That's where investor concern often lingers.
So the net debt to adjusted EBITDA ratio
dropped to 2.97 times. That's down from 3.2 times at the end of last year. Progress.
And why is getting that specific number down so important for the market? They have a target, right?
They do. Management is guiding to under 2.25 times by the end of this fiscal year.
Okay, under 2.25. Why does that threshold matter?
Two main reasons: cost of capital and, frankly, investor confidence. Hitting that target signals the business is generating cash quickly, becoming self-sustaining.
Improves their credit rating, maybe lowers borrowing costs down the line.
Exactly. And it just removes that overhang, that perceived risk associated with complex deals.
And the CFO seemed pretty confident about the path to get there. Acknowledged some spending early in the year, but expects.
What was it? A $30 million net debt improvement in the back half.
Yeah, a $30 million improvement. And that comes directly from that services flywheel spinning faster, plus lower capital spending now the big integration upgrades are done, and better working capital management.
So the financial discipline seems aligned with the operational success in services.
It really does. The house looks like it's getting in order, financially speaking.
Okay, but financial discipline doesn't mean much if you're not winning business. Let's pivot to the commercial side. What's driving that services growth? Well, the commercial engine looks strong, especially in those high-value areas. AI video bookings, for example, that's their premium stuff.
How they do?
Grew 52% sequentially.
Yeah.
52%.
Just quarter over quarter.
Yep. And the overall pipeline improved 28% sequentially too, driven by their big channel partners in North America. So the market seems to be really embracing these higher value tools.
And it wasn't just existing customers buying more. They mentioned new logos too.
Right. New customer wins grew 14% sequentially, and that was across both enterprise and mid-market in like 11 different industries. So broad appeal.
What's the key differentiator driving that? Is it the Unity platform itself?
I think so, yeah. They're successfully getting customers to ditch fragmented systems and consolidate onto Unity. The case studies they shared were quite telling.
Like Wholesome, the construction materials giant.
Yeah, Wholesome. Massive customer, 9,000 vehicles. After rolling out Unity, they saw an 83% reduction in critical safety events.
83%. That's not just saving money. That's huge for risk management.
Absolutely. Or Foley, the equipment dealer. They had issues with data from mixed fleets, different OEMs. Unity helped them solve that, leading to a 30% cut in maintenance costs.
So that OEM agnostic approach, being able to pull data from anywhere, is a big deal for consolidating customers.
It's huge. Makes the platform much stickier and opens the door for upselling more services later.
And that stickiness, that upselling, that drives higher value per sale, right? They talked about ARPO.
Exactly. ARPO, average revenue per opportunity, it's expanding.
Talk about ARPO for a second. Why focus on that specific metric? What does that $30 to $125 range they mentioned signify?
Well, ARPO basically measures their ability to sell more software, higher value stuff into each deal or each customer. Historically, their average was lower, maybe focused on basic tracking.
Gotcha.
But management highlighted wins like Six Rental Mexico are driving a sweeter mix, as they put it. That 30 to 125 ARPO range, that's specifically for the high value solutions, warehouse optimization, complex tracking, and especially that AI video piece.
So it shows they're successfully moving customers up the value chain. From basic dots on a map to real enterprise intelligence.
Precisely. Higher value, higher margin business.
Okay, looking ahead now. The big partnership news was with MTN Business. Sounds potentially significant?
Oh, it's a potential force multiplier. Absolutely. MTN Business, huge network provider, right? They chose Unity to white label for their own enterprise data solutions.
Across how many countries?
16 countries. This gives PowerFleet instant access to a massive, largely untapped market.
Without needing to build out their own sales teams everywhere.
Exactly. It's a massive validation of the tech and dramatically expands their addressable market, basically overnight.
And they're getting some external nods for the innovation, too. ABI research.
Yeah. ABI named them one of the 7 most innovative global tech companies. They specifically called out the AI-led innovation and that hardware-agnostic approach we talked about. So, yeah. Commercial execution and tech recognition.
And that AI innovation is actually hitting the product now, the AI risk intervention module.
Yes, launched within Unity. It does real-time detection of things like fatigue, distraction.
Yeah.
Allows for proactive intervention.
And the claim was it could reduce manual video review hours by
over 80%.
80%. That's got to be a major selling point. Enterprises are drowning in camera footage but need actual insights.
It's a huge pain point they're addressing directly. That kind of efficiency gain translates straight into lower operating costs for the customer, which helps justify paying a higher ARPO for the service.
Makes sense. But management didn't just paint a rosy picture, did they? They acknowledged some headwinds.
No, they were upfront about it. Mentioned ongoing customer caution because of the general macro uncertainty, and also tariff frameworks hitting the product side, the more traditional hardware CapEx-heavy deals.
So how are they navigating those risks?
Well, their response is key, I think. They're intentionally doubling down on the software-led solutions, pushing AI video, pushing the services segment overall.
By getting that services mix up to 83%.
Exactly. They're basically insulating the business, making it less vulnerable to those lumpy, CapEx-driven product sales that tend to get hit first when companies tighten their belts. It's a smart strategic pivot.
Okay, makes sense.
All right, let's dive into our This Is Not Financial Advice segment. We cook up an outrageous, but, maybe plausible trade idea based purely on the story told in the earnings call.
Okay, hit me with it. What's the core narrative we're betting on this time?
The thesis is pretty straightforward, actually. It feels like the market is still pricing PowerFleet AIoT with this kind of integration risk hangover. Like, they're still worried about the mixed deal and expect a slow debt cleanup.
Okay.
But they might be overlooking the sheer speed of the SaaS transformation that's happening right now, that 53% year-over-year services growth, capturing $11 million in synergies already.
You're saying this significantly de-risks the balance sheet cleanup plan faster than people realize?
That's the idea. The stock seems to be trading at a discount because investors are basically waiting for the official proof of debt reduction numbers. They're pricing in risk that might already be evaporating.
So if we think that the business performance drives debt down faster than the market expects, how do we play that? How do we structure a trade around that sub 2.25x leverage target they set for year end?
Well, you essentially bet against the market's fear. The idea is to structure a trade expecting the market to anticipate hitting that leverage target well before the official year-end report.
Because that projected $30 million net debt improvement coming in the second half.
Exactly. That's the key catalyst. The market, or at least the smart money, might start re-rating the stock as soon as they see clear signs that debt is dropping rapidly in Q2 or Q3 results, even if the final sub 2.25x isn't confirmed until the Q4 report months later.
So you don't wait for the final confirmation.
You try to get ahead of it. So the trade could be selling out of the money put options, maybe expiring in the next couple of quarters, Q3 or Q4.
Selling puts below the current price.
Right. You collect premium now, benefiting from that elevated integration risk perception that might be inflating option prices. Your bet is that the strong operational execution cleans up the balance sheet ahead of schedule, removing that big psychological barrier for investors, causing the stock to move up well before those puts expire worthless.
Interesting angle. Betting on the narrative becoming reality faster than priced in.
That's the essence of it. Again, outrageous but plausible, based purely on the call's momentum, not financial advice.
Okay, so wrapping up this deep dive on PowerFleet. Definitely a strong Q1. The story seems to be rapid acceleration.
Yeah, driven primarily by that big jump in the high-margin services mix, hitting 83%, and really impressive efficiency gains, grabbing those $11 million in synergies already.
The transformation plan seems to be clicking. They're using that Unity platform, the OEM agnostic angle, to win big deals, expand margins.
While simultaneously cleaning up the balance sheet and, smartly navigating those macro concerns by leaning into software.
All right, so here's the final provocative thought for you, the listener, to consider. Management brought up their multi-year goal, again, reaching the rule of 40. That elite SaaS benchmark, right? Growth rate plus profit margin equals 40 or more. Given that their Q1 adjusted EBITDA already grew 58%, how much faster could this quick shift to 83% services, plus maybe more synergy benefits, actually accelerate their path to hitting that rule of 40? Could it happen sooner than people think?
That acceleration speed, that's probably the key question for the long-term valuation here. Definitely something to watch. As always, do your own research.
Absolutely. Thanks for diving deep with us today. We'll catch you on the next call.